Hey, what up, y'all? Welcome back to the Runaway Slave Project. Today's episode is going to be a quick crash course on investing in the stock market as a beginner. And I'm going to be giving you guys my top 5 tips for beginner investors, okay? So stick around for that. And the reason this video is so important is for 2 reasons. Number one, this is the best time to start investing because the market is seeing so much volatility and we're starting to see early indications of a potential crash, maybe even a recession in the very near future. And when people start hearing those things, they start to panic and pull their money out, causing the stock prices to dip even more. And that's the best time for you to get in and start buying shares at a lower price. The second reason is because as a parent, I think that the worst thing you can do is leave this earthly realm without putting your kids in position and building wealth for the generations behind you. And I tell people this all the time. If my parents would have purchased, let's just say 1,000 shares of Microsoft when I was a kid, well, right now I'd be worth about $250,000. And if they would have purchased, let's just say 100 shares of whatever company, every year for my birthday, I'd probably be sitting on 7 or 8 figures, easy. And that's the thing about investing in the stock market. We have to get in now. We have to get in early while our kids are young. That's the best way to give our kids a fair shot. So before I give you guys my top 5 tips for investing in the stock market, we must first understand what does it even mean to invest in the stock market. And a quick example of this would be, let's just pretend that you wanted to invest in a company like Tesla, which is currently trading at like $269 a share. And what a share is basically a fractional portion of a company that holds a certain value. So let's say you want to invest in Tesla. You say, hey, Tesla, here's my $269. They're going to take your money and they're going to repurpose it for things that are going to make their company more valuable and more profitable. And what that's going to do is that's going to make your particular portion that you own more value and more profit as well. So that's what it means to invest in the stock market in a nutshell. Now, things do get kind of complicated when we start talking about commodities and mutuals, bonds, and stock options, calls, puts. Things can get a little bit more complicated, but today we just stick into the basics, okay? So now that we know how to invest in the stock market, we know what a share is, where do we go to purchase these shares? Well, you got to open an investment account with a brokerage firm. And I'm pretty sure if you've had a job that offers a 401k plan, you've probably heard of companies like Fidelity, Charles Schwab, Merrill Lynch, TD Ameritrade. These are the traditional brokerage firms that people have used over the years. And these are the ones that I use for my long-term investments, okay? My commodities, my REITs, my indexes, ETFs. These are the companies that I use. Now, in the past, several years, we've seen a huge influx of these mobile apps like Robinhood and Webull and Public. And what I like about these mobile apps is they've not only made investing so much simpler, but they've made it more accessible to the average American, because literally all you have to do is download an app, link your bank account information to that app, and just start scrolling until you find a company that you want to invest in. It's as simple as making a purchase on Amazon or Fashion Nova or something. They've made things so much simpler, and it's no excuse why you shouldn't be investing, because even if let's just say you don't have $260 sitting around just to invest in Tesla. You may only have $50. You can purchase a fractional share of those companies. So you can tell Tesla, hey, I don't have $269, but I got $50. Here's my $50, and you can still get involved in investing. It doesn't matter. So there's no excuse why all of us shouldn't be investing. All right, now we got all that out of the way. Let's go ahead and get started with the list, starting at number 5, and that's going to be research. Research. And I'm not just talking about researching the companies that you're looking at investing in. I'm talking about learning everything that is involved with investing. Because most people, what they'll do is they'll just look at that little graph, and that's what will determine if they're going to buy a stock or not. But no, it goes so much deeper than that. You actually have to scroll down. If you scroll down underneath that little graph, you're going to see all kinds of other terms and abbreviations and numbers. Find out what those things mean. You need to know all of this stuff. You need to know what is CapEx, what is OpEx, what's a dividend yield, what's a PE ratio. You know what I mean? And not only that, go a step further. What was the last earnings call about? Did they hit their numbers? Look at the balance sheet. Look at the cash flow summary. You need to know what these companies are investing in. How much outstanding shares do they have? Are they buying back shares? These things will determine whether you're overpaying for a stock or not, because that is a thing. Just because a company says our shares are worth $120 a share doesn't mean that that's true. You have to know how to analyze a stock, and understanding what those definitions mean is the first step to get you there. And tip number 4, study the greats. Just like somebody who's looking to get into football or basketball, you want to study the film of Kobe Bryant or Michael Jordan, LeBron, because these are the guys that came before you, and you want to imitate and mimic the things that they've done in that particular profession and put your own little twist to it. Well, it's the same thing with investing. So me personally, I always go back and I read every article, listen to every interview, read every book from guys like Warren Buffett, Charlie Munger, Peter Lynch, Mike Bloomberg, the list goes on. And I'm not talking about these overnight YouTube sensations that are just spewing information on the internet. I'm talking about guys who have substantial experience as far as the stock market is concerned. Now, tip number 3, and the most important tip that I'm going to give you today, is keep your emotions out of it. Because what you got to understand about the market is this is not some kind of get-rich-quick scheme, okay? The market is about long-term growth. You put your money somewhere that you feel confident, and then you just watch it grow over time. And you also have to back away from the TV, because if you're watching Fox Business and Bloomberg and Yahoo Finance, they're gonna sell you that fear. They're gonna tell you every week it's a crash coming, or the market is soaring, you need to buy more. Hey, no, sometimes you gotta step back and strategically figure out how you're gonna proceed. I'll give you guys a quick story. I remember mid-February of 2020, during COVID, the Dow Jones had gotten up to 29,000 points. And within 2 to 3 weeks, it had took a deep dive down to 19,000 points. And it sent the market in a frenzy. And I remember one of my coworkers came to me and he was like, "Oh my God, Brandon, I got to pull all of my money out, man. We're about to lose it." And I'm like, no. Don't pull your money out. Sit back, relax, turn the TV off, and strategically figure out what you got to do to get through these times. And I had to explain to him, the market has always gone through tumultuous times. We've always had crashes, depressions, recessions. We've been through bubbles. Bubbles have burst. But historically, the stock market has always recovered. And even top economists will tell you, don't let a good crisis go to waste. This is the time to make money. As those stocks are dipping and people are pulling out of the market, but that historically the market has always recovered, why would you pull out? When it comes to investing, the most successful people are the people who focus on the recovery phase instead of focusing on the potential loss that they could potentially, suffer. And that brings me to tip number 2, buy the dip. And you'll hear YouTubers throwing this phrase around like crazy, buy the dip, but they don't really put it in context. This only applies to companies that you're bullish on and that you're super confident that they will recover from these tumultuous times. So these are going to be companies that have a proven track record. Not some company that's been around 2 or 3 years, but companies that have historically sustained themselves on the market. Like for me, a company like Microsoft, when it dips down, I'm buying more because Microsoft is one of the only companies that survived the dot-com bubble of the 90s. They've survived 9/11. They've survived the 2008 crash. They've survived COVID. And they are one of the tech juggernauts on the market. So that's a company that I'm bullish on. And so I'm going to buy them whether they're doing good or whether they're doing bad. Because during these times is when I take advantage of it and I try to get my dollar cost average as low as possible. And what I mean by this, let's pretend that I bought 10 shares of a company at $10 a share. And then that company went up to $15 a share and I bought 10 more shares. Well, my average cost per share is $12.50 per share. Now let's say that stock dips all the way down to $5 a share. Instead of buying 10 more shares, I'm going to buy 20, 30, 40 shares to try to get my dollar cost average as close to $5 per share as possible. So let's just pretend that I bought 30, 40 shares and I've got my average down to $6 a share. Knowing that the market is going to recover, when it does get back up to $15 a share, I've just made more profits than I would have if I would have just let it sit at $10 or $12.50 a share. See, that's the mentality you have to have when we're talking about investing in the stock market. As long as you know that the market is going to recover, that's the time to buy. But like I said, this is only for companies that have that proven track record, okay? Safe companies. And that brings me to tip number 1. Play it safe. Because as a beginner, you should be investing in historically successful companies that have been around for a long time. Like I mentioned earlier, Microsoft, companies like Coke, which has been around over a century, Disney, Apple. These are safe bets, and that's what you want to do. You want to minimize your risk level as much as possible as a beginner, until you get your feet wet, until you kind of get a good grip on playing around in the stock market. So as a beginner, like I said, I play it safe. I'd even go a step further and say investing heavily in things like ETFs, which stands for exchange traded funds. And what this allows you to do is invest in an entire sector or an entire cluster of stocks, but under one ticker symbol. So let's just pretend that you are a tech guy like me, and you wanted to invest in a lot of these tech companies, but you don't want to bank on the individual performance of these companies. So you can just go and invest in ETF like VGT, which covers all of those top tech companies. You know what I mean? So it's just a safer way to invest. Like I said, when you're starting out, you want to play it safe. I would say 95% of your portfolio should be ETFs, indexes, REITs, commodities, which are like gold, silver, precious metals, crude oil, things like that. Just things that are more, that just have a more conservative approach, okay? So that brings us to the end of this video. I'm glad you guys stuck around. I know this was a long one. And like, share, subscribe, comment, hit the notification bell, and we're going to see y'all on the next go round. Peace.